1 minute, 1 minute. Is it live? If anybody hears anything, just write to the chat and we'll start. Okay, I see it's live. Then let's start. So today we'll start with the risk management. So it's a big topic. So we'll start with the very basics, right? And we'll start with the risk management of trading, say, one second. So what do we do as a trader to do risk management on a trading account, right? So we'll start with the very basics. So you probably already know all these things. So let's recap them. So on a trading account, we have the balance. It is the how much money we have, right? We'll be talking about how this works in MetaTrader 4 and 5 platforms. It is like those things are pretty similar among different trading platforms. There are differences, but I think if you're familiar with these concepts, you will find similarities with how these things work in other platforms. So let's go forward with the MetaTrader 5 in this case and see where it goes. All right, let's quit ChatGPT. So we have the balance. Balance is how much money we have on this account. In this case, $10,000. This is not true though, because we also have equity and free margin, right? So all of them show 10,000. So how are they different? How are these numbers different, and what do they show? Actually, they become different. Like if we have no open positions, these things are the same. So they show how much money we have. But if we have an open position, like at least one, let's do the buy. Oh, this is euro dollar. How do I buy? New order. I will buy. So once we have a position, these numbers start being different, right? And also we have some additional numbers that pop up, right? So what do these show? Balance shows how much money we would have if we didn't have our open positions, right? So we had 10,000 exactly before we opened the first one, the first position, the first and the only, right? So it is how much money we would have if we didn't have this position open, right? So, or if we had like two positions, whatever amount of positions we open, we have the balance exactly the same in this case, right? So it says how much money we would have if we didn't open these two positions. But we already did, right? So it's not actually the amount of money we have. So this is like a hypothetical amount which does not take into account the reality that we actually did open these positions. Equity shows how much money we would have if we close these positions. right now, right? So this depends on current time. And while we have open positions, the equity also changes and shows how much money we would have if we open the position exactly, if we close the positions exactly right now, all of them, right? So basically, equity is equal to balance plus so-called current P&L, current profit and loss among these positions. We could say it's profit, right? Because we could say loss is a negative profit, but let's write P&L because people also call it this way, so that for people who are not very smart to understand that the profit could be negative, right? So we just say profit and also the loss, right? so so in total, if we say the total profit here is minus 43 and whatever, right? So basically balance is exactly, the equity is exactly balance plus the profit. And it means what if we realize this profit? This is how much money we would have on the account. This number takes into account the reality that we did open these positions. So equity is actually the amount we have on our account. So it's not exact number because it changes every second while there are new prices coming, because profits and losses are jumping up and down. But this is the closest we can have to the actual amount of money we have, right? So if we have a lot of losses, it means that our equity will be smaller, much smaller than the balance, and it will reflect the reality that we have less money. As of what are the next numbers we have? Margin is how much money is spent from the money we have, how much money has been spent on the positions that we opened, right? So basically, this is the amount of money that is locked on our account and we cannot use it. We can really, right? But we should. It has been temporarily taken away from us, and by the positions that we have open. If you remember, when we had no positions, we didn't have the number. The number was 0, and we have 2 positions right now, and the number will become 0 if we close these 2. Let's do that, right? So okay, I'll accept the terms and conditions, and as I close the open positions, the margin becomes smaller, and now it's 0, right? So it shows how much money has been used up temporarily by the open position. And what does the number, how do we get this number? Like this number plays together with the concept of leverage, right? So we have a Forex account, we are trading currency pairs here. So usually we're provided some leverage to trade on these instruments. And the leverage means we can buy something which costs more than how much money we have, right? And in our case, we bought one lot of euro dollar, which is exactly 100,000 euro for dollar. So basically we opened a position, we bought 100,000 euro, but we only had $10,000. And this is what leverage offers us. In our case, I suspect the leverage is 1 to 100. It means that we can buy $100,000 with just $1,000. And we can buy 100,000 euros with 1,000 euros. And this is exactly the amount of 1,000 euros. So essentially, to instead of giving away by buying euro dollar 100,000 euro for dollars, we would have given up $108,900. But instead, because we have a leverage of 1 to 100, so we can actually pay much less for this amount, and we paid 100 times smaller amount. We didn't pay exactly. We will get it back when we close the position. So we didn't lose this amount, and we'll see further how it works with other numbers, right? So this amount shows how much money has been used up, and what is the amount that has not been used up. In our case, it's called free margin. So free margin is how much money was not used up by the margin. So in our case, equity is the amount of money we have. Margin is the amount of money that has been used up, and free margin is the equity minus margin. So we have free margin is equity minus margin. So how much money we have right now minus how much money we have used up for the positions that we have. And this is the amount of money that we can still spend, right? So we spent 1,000. Can I buy, can I buy one more lot? I can. I still have $7,000. Can I buy one more lot? Yep. I can still buy 6 more lots approximately, right? Let me try that. Yep, I did, and I used up all my money, right? You can see here as that my free margin is almost zero, and it sometimes goes to a negative amount, which means when it's less than zero, I cannot open any more positions. Say, okay, can I buy a little bit more? 1,000 euro, can I do that? I don't have this amount actually. Let's see what happens. It says not enough money. This error means that we don't have enough money. And this, what is enough? It means that free margin, how much money we have free to spend on margin, we don't have enough. In this case, we don't have 1,000 euro more. And what else do we have? We have the margin level. So this concept, this is, let me just write down what this is, what this number shows. This number is equity over margin. Equity divided by margin. So this is it's times, like if we do in percentage amount, right, we do times 100. So it shows what percentage, what does it show? By how much amount of money we have exceeds the amount of money that has been used up, right? So basically this number is important only for a single reason: to know when you will get stopped out, and we'll get to that. So we'll talk about the risks, right? So you can see that the point when free margin is 0 is the same point, actually, when margin level is 100%. So when equity is equal to margin, free margin will be 0, and margin level will be exactly 100, right? So this is the point where we have no more money to open more trades. We can only close trades to as a way to free up the margin. Let's actually do that. Say I will close one of the positions, and my free margin grew, so my margin freed up a little bit. My margin decreased by the amounts that was released by the closed position, and my margin level grew, right? So as I close positions, my margin level grows bigger and bigger. And when I close all of the positions, what will be my margin level? It's not shown, but it is technically infinity, right? So margin taken is 0, so we divide by 0, which is not allowed, but in this case we could say that margin level is infinite. It is higher than any number. So why do we need the margin level? So okay, so where were we going with these numbers? We were going about risk and risk management. And what is risk? Risk is when there is a possibility that you lose, right? I mean, risk for somebody that somebody loses, right? It's not the loss itself after it happened, but the possibility that you will lose in the future. It's not certain, it's not like 100%, but if something could happen, it is a risk, right? And we could quantify the risks in different ways. And also risks could be bigger, smaller relative to each other, and of different origin and of different severity, right? So some things that could happen, like you could lose money, you could lose a hand, right? And in many cases, losing a hand is worse than losing a lot of money, right? So there are different things that could go wrong. In our case, when we're talking about financial systems, risk is mostly losing money, right? Sometimes it's also going to jail, but it's probably not related to finance. It's more like law, regulations, etc., which we're not touching in these lessons. We're just talking about risks that could lead to making some numbers smaller, right? So losing money, and some number on a screen will go in a negative direction. It will become smaller. So we have $10,000 here. We already earned $70. Congratulations, guys. Let's proceed. So we traded and we won, but we could have lost, right? And the first thing on which we could lose money is, of course, losing by making an unfavorable trade, right? So when we make a trade, well, this is a small trade, I don't like it, let's make a bigger trade, let's do one lot. We immediately start losing because of the spread, so we buy at a higher price than we would sell at, and later the price, in this case euro dollar, could go up. In this case we win because we bought, or it could go down. In this case we lose. And this is the risk. And how do we protect from the risk of losing in case of price going in a way that we don't want it to go? We could protect from it to some extent, right? You cannot avoid any losses, and we will talk about them further when we talk about stop loss, take profit, and trailing stop. But before that, we'll finish with the margin levels, since we started with them, right? So the second way to lose money is to get stopped out. right? So for example, if we open a position and we start losing, as you saw, we were losing, but now we're close to winning. We're actually winning right now. So if we start with losing, at some point in the future, we could win, right? So technically, if we open some unfavorable trades, after some time, the price could go in our favor and we would win eventually, right? At some point, the price will go in our favor, most probably. So to prevent that, but we would need to wait, and we would need to not close trades which are losing, because if we close them when they're losing, the loss is ours. But it could lead to a situation that we had the $10,000 on this account and the losses could exceed the $10,000, which means we would have negative equity, we would have negative money, which means we would be owing money to our brokerage company. And people usually don't like that when they owe. And in many cases, and under some laws, you are not obligated to pay the negative amount, to cover the negative amount. That's why your broker, does not like you owing money to the broker. And they will stop out your account before you lose all your money. So they will close your trades at a loss to prevent you from losing all of your money and to become indebted to the broker, right? So that because they don't believe you will pay your debt. How does it happen? Say if we have these trades and can I make these trades more lossy? Can I? At price. No. I cannot do it from here, right? Modify. Oh, I would need to do it from another terminal. Okay, let's do it in some other way. So we could open a very large trade, how much money we have, and at some point we start getting losses here, and our broker might want to stop us from losing further than the amount we have. And they do it by closing the positions at some point. When do they do it? When your margin level reaches some dangerous amount. So when it's 0, it means you have no money left. So some amounts between 0 and 100% is the margin level at which they will stop you out. Usually it's like 50% or 30% or 70%, depends on your trading account. So when we reach, in this case, 70%, the broker thinks that we are losing too much and they will close our trades and we will realize these losses and lose them forever without the chance of them rebounding and becoming profits. So this is why you need the margin level. It's just to track whether you're close to the situation when all your open positions get stopped out and closed forcefully without your intervention. Okay, so we were talking about limiting the losses, right? So we have made some trades and they are losing money, but we don't like that. How do we prevent ourselves from losing money? We cannot, but we can limit how much money we lose. And we do that by setting stop loss level. So this is the current price, and we say if the price goes to this level, just close and don't lose any further. This is a buy trade. So when ask goes to this level, in this case the red price, when it touches this level, just close the trade and don't proceed with losing more money. In our example, we cannot set the stop loss too close to the current price, but let's put it here. So this way we effectively limited our losses by this amount, right? So not this amount exactly, by the amount of loss that will happen at this price. And how much is it in this case? It is, say, if we go to this level, it's 8.4. It's not this, right? 3/8 minus 8,986 1 9 86. So by 100,000 euros. So this is also 7 lots. So technically, when the loss becomes $714, euro, right? So 714 euro in USD. When we have this amount of loss, $778, this trade will close automatically. How will it happen? It will happen like this, like it will get closed automatically. Even if we close the trading account, the trading terminal. In the same way, we can limit the profits. Say, I'm not greedy. If the price reaches, in this case, ask price reaches this amount, we want the trade also to close, but in this case, the take profit is in favorable direction. So when we have the positive profit and the price reaches this amount, we will close with the current profit. But I just noticed that the open price is like this. It's higher than the take profit, so it means we will still close at a loss in this case, right? Because the take profit price is higher than the current price, but it's lower than the initial price, so we will still have some loss. But we say we have enough at this point. We don't want any more further movement. We don't want to wait for any further movement because we don't want to risk going into negative direction. And also, we'll see the last third thing I wanted to talk about is a trailing stop. We have this option of trailing stop. I have a question. Another way to lose money is swap, right? It's not about losing money. It's like a commission that you pay. So you technically lose money on commission and spreads, etc. But it's the cost of trading, right? So it's not a risk in this case. So it is a loss. It's not a risk because there is it's not a possibility of losing this money or not losing. You know that you will pay the swaps every day. So you expect this to happen, you know the amount that you will pay, and so it's not a risk. So you know that if you keep your trade until tomorrow, you will lose this amount. So it's not. I don't consider it a risk in this case, and it's not about managing this risk because you know it will happen if you leave the trade overnight. So yeah, and the commission, right? You know that you will lose the commission if you trade, right? So when you trade, it's not a risk because you know exactly how much you will pay. So back to trading stop. So trading stop is a let's start afresh with a new position. Where was it? It says if we do like this option, trailing stop, and I set it to 30 points, it means that, let me draw in this case. It is a conditional setting of stop loss that will be automatically moving dynamically. Oh, wait a moment. Here it is. Say we have the current price, right? It goes like this. And at this point, you have entered a buy trade, right? So this is the price at which you entered the buy trade. And for you, it's good if the price moves up, and it's bad if the price goes down. So you set up the take profit at this level. Let's say take profit at this level, and you set up stop loss at this level, right? So your idea is if the price goes here, you will win this amount because when the price goes here, take profit is triggered, and this is the amount of profit that you make, right? The price went in your favorable direction. And if the price goes here without touching the take profit, you will lose this amount, right? So price went against your favorable direction, so you lost, and this is the amount, the maximum amount you were willing to lose. So you say the price goes this way and hits this level, you say, okay, close my position, I don't want to lose anymore, because the price could go even further, right? And you could be losing even more. There is a risk of losing even more. And so what if, as you saw, the price went favorably for you and reached this level, right? So the price went like this. And initially, you wanted to earn, for example, $100 here. So at this point, when the price reached this level, your stop loss is, for example, $170 away from you, right? So if the price goes down from here, you will lose $170 from the current place. Wouldn't it be nice if your stop loss also moves up as your price goes in your favor? So that, for example, if the price went here, we could also move the stop loss here so that it's still $100 from your current price, but in this case you will lose smaller amount from the initial one, right? So if the price went partially in your favor, not until it hit your take profit, but say it went half of the way, you could also lift your stop loss higher to limit the losses even further because the price already went in your direction. So this mechanism of automatically moving the stop loss along with the price which goes in your favor is called trailing stop. So the stop loss will automatically move with your price as long as the price goes in your favor. And in MetaTrader, it works like this. You set the trailing stop and you say, I want the stop loss to be no more than 30 points from the current price as the price moves in my direction, up in this case. How do we make it happen? Let's make two orders. Let's lose some money, make some orders. Say I do one lot buy and I do one lot sell. And I say that trailing stop will go 10 points. Can I do 10 points? Oh, it's 30 only, minimum. Due to the settings in the group, I guess. Now, why doesn't the stop loss appear after I set the parameter? In MetaTrader 4 and 5, it appears after we break even. So I expect the price to move. Why is the price not moving? I wonder. Are we connected? I don't know. I guess we are connected since we opened some trades, right? Can we open? Yep, we can. But the price is not moving. Is it the end of the trading session on Friday? Do we have any movement on Forex? I don't know. Let's go to another account. So we have even more money here. Where is our money? And we do the trades. One lot we buy, one lot we sell, and we set trailing stop to, oh, perfect, 5 points and 5 points. So in MetaTrader, the trailing stop will kick in only after we earn this amount of points. You see? Okay. So the stop loss immediately appeared and it got activated because it was too close. Let's open new positions. Now this is both buys. I do the sell. And I set the trading stop a little bit farther, say 15 points. Can we do that? And let's see what happens with the price. So once the profit reaches 15 points, in this case, it's $15, right? The trading stop will set the stop loss at a level of 5 points from the current price. Okay, we have our trailing stop, and it will update automatically as the price goes in our favor. You see, the stop loss is moving. So as the current price goes up, the trailing stop also keeps following the current price automatically. So our worst case in this case, we already have the stop loss above the price, the original entry price. So even if the price goes against us, we will only lose 15 points in this case, 15 points. So let me close this trade, and we can see here is the line of the stop loss and the current price, right? So as the price goes up, I hope it goes up to show us, the stop loss will follow it upwards as well. Or in this case, we got the position got closed by the stop loss. Let's try again. We opened the buy, we opened the sell. I'm doing that so that I don't care in which direction the price goes, up or down. I just want the stop loss trailing stop to activate. So either buy or sell position will become profitable after some time, after some price change. And this is the points when trailing stop will kick in. Any questions for now? So by using trailing stop, we're managing our risk of losing on these positions by changing by setting the level of maximum loss that we're ready to suffer. And the trailing stop is the way to automatically change the stop loss if the price goes in our favor. Let's see. So it shouldn't it be 10 points? Oh, it's 15 points. Okay, so this one kicked in. So as you see, the trailing stop, it already allows us to close higher than the original price. Here is the level, and as the price, if you can see the small line, okay, it got activated again, the trailing stop. Let's again do the trailing stop. 15 points, is it fine? Let's do 10 points so that it kicks in faster. Now we're trading, right? I'm getting nervous of losing or not winning. This is a trading stream now. Okay, we have the trailing stop here again for the buy position, and as the price goes up, the trailing stop will follow. Okay, you see, it follows the price. It goes up also with the okay, it happens again. So this is how trailing stop works. And thank you for coming today, and have a good day. We'll go about different topics